Okay, good evening to everybody. We will begin our workshop in about 4 minutes time at 7:30 sharp. So make yourselves comfortable and I will begin very soon. Okay, very good evening to one and all. Welcome to my workshop, and I'll be sharing with everybody a stress-free strategy to get out of the corporate rat race. All right, and before I begin, all right, I'm going to share with everybody a disclaimer where I make reference to investment securities. They are meant to demonstrate investment concepts. They are not an actual buy or sell recommendation. And myself, Dr. Wealth, shall not be liable for any losses or damage caused directly or indirectly by the material contained in these notes. All right. Now, with that out of the way, all right, my name is Christopher Nguai Chong. I have degrees in engineering, applied finance, and law. I've spent 14 years in the IT industry, and during that time, I authored 3 books on personal finance, and one of my books was a bestseller in the year 2005. I've appeared twice in the Me and My Money column on the Sunday Times, and I've also appeared on Money Mind recently. And the reason why you're listening to me today is because I've probably gained financial independence at the age of 39. All right. And my goal for this evening is to share with everybody and to explain in very simple terms, right, how to retire early. All right. And our agenda for this evening, all right, we'll be talking about our life in 4 seasons, all right, breaking down our existence into 4 periods in our life: spring, summer, autumn, and winter. Then we will take a short little break, and then I'll talk for 20 minutes about the early retirement masterclass program that I have for you, and it's running in June. And we will end the evening with a Q&A. So if you have any questions for me along the way, you can put them up on the chat. I'll do my best to answer them to the best of my ability. And let's begin. All right. So let's talk a little bit about our lives. And very briefly, our lives can be broken down into 4 seasons: season of spring, season of summer, season of autumn, season of winter. All right. And let's begin our discussion with spring. And spring is a period where we spend most of this time, schooling, starting out in our career. Okay. And for me, my early influences came from a retail background. My parents are one of the founding partners of probably the most commonly found pet shop franchises that you still see in Singapore today. All right. So my dad is actually one of the founding partners of this business. And I grew up at Shaw Centre, where the first pet shop was located. And very early in my life, I was shaped by the experiences of a person growing up in a retail kind of environment, where if my parents do not generate enough revenue to pay for the rent, they would often fight, right? And that's the kind of reality you have if you are brought up as a shopkeeper, right? So because of that, right, you will find that the way I invest and the way I behave, it's very similar to that of a landlord, right? Very similar, all right? Except actually more relaxing than being a landlord, all right? And spring is a time where you really take stock of what sort of influences your relationship with money, right? And one of my earlier influences as I started work is that I realized that we can't really trust financial advisors. So as I was about to enter national service, my mom got for me a insurance program. And this insurance program is supposed to pay for itself when I start work. But ever since I started work, the letters for the requesting for premiums just kept coming over and over again. And we actually brought a letter of complaint to the company. And they offered me 2 choices. Either I carried on paying for an unknown period of time, or I could drop and allow the policy to lapse, but the policy would generate protection for me. But what I wasn't entitled to is to be able to obtain any of the funds that I get back from the insurer, right? And so because of this, I very early in my life, I developed mistrust for financial advisors. It actually didn't help that the person who sold that policy to my mom eventually went to jail for criminal breach of trust, right? But I think that was a very formative experience in my life, right? And you realize that I was able to build a much larger portfolio than a lot of other people because I simply do not end up spending a bulk of my salary on premiums, right? Yeah. And so one of the things we know about going through spring is that personal finance is not taught very well in school, right? Money is not a subject that is examinable, right? You're taught to be an obedient employee, follow instructions, do rote learning. And the consequences of compound interest is not shown to secondary students of my generation, right? And obviously no one really understands how crippling it is to pay these sales expenses for investment products, right? That actually, I think, plague a lot of middle-class Singaporeans today, right? So some of the questions then is, if something is missing from our syllabus in spring, then how should we pick up these crucial personal finance skills, right? So this might be a question that you're asking yourself, right? And as it turns out, for the folks in my generation, the missing X factor can be done by reading books on personal finance, right? And so 20 years ago, a popular book would be Rich Dad, Poor Dad by Robert Kiyosaki. And if you read it, it would really inspire you to learn a little bit more about personal finance. It's highly motivating, except it doesn't really teach you how to invest, right? Robert Kiyosaki's books are actually motivational, but they don't actually teach you any technique, right? Yeah, very much like the kind of investment trainers and options traders in the 2000s. Yeah, they can spend a lot of time motivating you, but they don't actually teach a lot, right? It's only after reading 4 to 5 books by Robert Kiyosaki that I realized that I was duped, because he's actually a creature of multi-level marketing, right? One of his books, The Business of the 21st Century, actually subliminally tries to program you to be more open to the idea of joining a multi-level marketing downline. And that is a plague, right, for the people in my generation, right? You got friends inviting you to all these seminars where in order to start your own business, you have to pay money to buy a batch of often wellness goods or nutraceuticals, right? And it's actually poisoned a lot of friendships, and it's affected a lot of relationships, right? I even worked for a company where their managers who are MLMers, right? And they would press employees to actually get into your downlines, right? It's basically how toxic the entire arrangement is, you know? And of course, the bad news goes further, right? If you spend your spring studying finance as a discipline, right, you realize that financial models don't really help you become any wiser, right? Finance 101, one of the models is the discounted cash flow formula. And you find that it's very difficult to actually put a valuation on, for example, an asset, right? First, you need to come up with the future cash flows, right? Then you need a crystal ball. You have to predict whether there is a pandemic in the future, et cetera, et cetera. And then on top of it, you need to discount everything to the present with a discounted rate. And this discounted rate is very subjective, right? Are you going to use the inflation rate, the 10-year bond rate, weighted average cost of capital, questions like that, right? And when you apply the formula in your own way, you find that the valuation of whatever you've done is significantly different from like another analyst who comes up with a different set of assumptions. And this really hurts and sort of affects retail investors as well. When you read a brokerage statement, you find that the target price of a stock varies from brokerage house to brokerage house, right? And it creates a lot of confusion for a lot of investors. Then what is right and what is wrong, right? We don't really know, right? Yeah, one way to get a grasp of investing the right way is to start with the right books. And I think one of the better books out there is Josh Claeson's The Richest Man in Babylon. And so you can take a snapshot of this page and look for this book in the library of Kinokuniya. If once you're motivated, when it comes to investing, you could pick up The Conceptual Foundations of Investing by the Cornells. That is also a great book to give you an introduction to what investing is like. All right. Unfortunately, these books are American, and books written by Singaporeans for Singaporeans are actually quite rare and generally not as comprehensive. All right, which is why the books I recommend tend to be written in America. All right. So I think Spring is really about the importance of personal finance as a life skill, about why we lack these skills. And a lot of us spend the bulk of other seasons trying to catch up on what we've missed out, right? Money is such an important thing in our lives. But the funny thing is that we've not really been examined on it, right? We pick up qualifications to get a job, but we don't really have qualifications on how to manage our own money, right? Yeah, so that's what I really want to leave with you when it comes to spring. So with that, we've come to our second season, which is about the season of summer, right? And you spend most of this time making your money, you start a family at this stage, all right? And most of you guys who are listening to me would still be going through summer. So I'm going to spend a little bit more time talking about it, all right? And for my summer, I worked largely in IT outsourcing. And in the year 2005, I was still an IT professional. The government signed the Cooperative the Comprehensive Economic Cooperative Agreement with India, and it opened its doors to a lot of very highly trained Indian software engineers who came to compete with us. And it became much harder for engineers to actually get a decent income and a decent increment, right? And at the same time, there is an outsourcing wave that's moving work out of companies into outsourcing firms. So I had to make a decision on how I'm going to survive, right? With retrenchments and all that. It's not too different from what technology professionals are going through right now. We had something very similar 20 years ago. And so I made a decision that, I wouldn't let anybody dig my grave, right? I should be the one digging other people's graves, right? So I became an outsourcing professional myself. And my work would involve documenting some IT procedures, flying off to Kuala Lumpur to train a team in Kuala Lumpur, and then retrenching or reassigning the engineers in Singapore, right? And then flying off to Bangalore to do the same thing to the people in Kuala Lumpur, right? And I've done quite well. The bulk of my career and the money I made came from IT outsourcing, right? Until one day, I was out in Bangalore and I received an email that one of my colleagues in Europe, his contract wasn't renewed because his work wasn't required anymore. He locked himself inside a bathroom, he sealed it up, he switched on the barbecue device, right? And he died, right? He died from carbon monoxide poisoning. He committed suicide. And that was when I realized that IT outsourcing actually, it can be very toxic, very dangerous, okay? And it's not something that it's very unique to my generation. I find that right now, there are a lot of technology professionals and their pre-sales people who are also getting retrenched, but for a different reason, right? The reason is not because of engineers from India this time, but because of maybe artificial intelligence and overhiring that happened during the pandemic. All right, so that's a separate reason why people are losing their jobs, right? And so 20 years ago, I decided that I could carry on and do IT outsourcing, but I think I need to find a cure, right? It's like getting poisoned, right? So getting poisoned, but I find an antidote, and I share the antidote with people, right? So I spent the bulk of my evenings studying the CFA, and I picked up some skills in finance, all right? And then I realized how subjective these financial models are. They're not like the kind of physics and engineering models I learned as an engineering student, right? And then I realized that these models don't really work when you apply them into the world of investing, especially if you're a local investor. How do you do what Warren Buffett says, right? You buy something with a very low price to book ratio, then what? You take over the company and then you force the managers to unlock value from your company. Yeah, I mean, we are not at that level. We're not at that level, right? I mean, we can only study this in theory. Okay, but I was lucky, right? Because after going through 3 levels of the CFA, I began reading research papers, and some of these papers are highly actionable. And one of the papers that sort of really was able to influence my life is the idea that surprise, higher dividends equal higher earning growth, right? And it's written by Clifford Asness, who is a billionaire founder of AQR Capital Management. He's a hedge fund manager, okay? And in this paper, he says that the historical evidence strongly suggests that future earnings growth is the fastest when current payout ratios are high and slowest when these payout ratios are low, right? What it means is companies that are generous giving money back to the shareholder, they don't have a lot of cash to play with, so they don't engage in empire building, right? They are more down to earth. They don't decorate their offices with art. They don't install golden taps in their bathrooms, all right? And because of this, these companies actually grow faster than companies that actually retain their cash to engage in larger number of projects. So it says something about the wisdom and the ability to allocate assets of managers of that era, right, in 2003, right? And so at the time, I realized that, it's time for me to turn theory into practice. And this is sort of actionable. This is something which I can deal with, right? So that was what I did. I had unit trusts at that time. I liquidated them. I wasn't satisfied with the unit trust I had because the annual expenses was very high, 2 to 3%, right? And the sales charge was at least 2.5% at the time. So I moved my funds into companies like SPH. Many years ago, SPH was a good dividends company many years ago, not recently, okay? Right? So it was giving about 6%, and the bulk of the money came 4 days before my birthday on Christmas, right? So I was able to sort of really enjoy a company that could generate a very, very high interest rate for me at that time, right? I was still learning about investing. And I thought, wow, wouldn't it be nice, right? If I've got 20 to 25 companies like SPH paying me at different points of the year, right? And sort of this led to a very important sea change in the way I manage my life. And I want to emphasize to the people listening to me today that this is prior to this thing called the FIRE movement, right? And I basically discovered this idea of living on my investment income, right? To exceed my basic expenses. So my basic expenses as a bachelor is the horizontal line here on top. And I'm building an investment income that would gradually exceed my basic expenses. My expenses weren't very high because I just came out from university and I didn't change my standard of living, right? I was living like a university student and I was quite happy with the $600 allowance that I had. It's a princely sum, 20 years ago. $600 for a university student 20 years ago is a princely sum. So when I started work, I felt no pressure to increase it. I continued living with $600 and I did it for, I think, over 5 to 6 years. All right. Yeah. So I was able to very quickly reach a point where my dividends sort of exceeded my basic expenses. All right. And that sort of occurred at the age of 32. All right. And by then, I was spending about 1,001, right? About of my money. Right. And then thereafter, I figured out that I could become a millionaire if I just farm my salary into the portfolio because I didn't need my job anymore, right? So that was the prototype of my version of financial independence. We weren't talking about retirement. I was merely thinking about becoming a millionaire, which is something that is more relatable for people of my age, right? People who are heading towards your 50s, right? And so in summer, we are looking at a new trend, and you look at Generation Z, right? And maybe the younger millennials, that your work is not as engaging as before. During the pandemic, people were engaged in the Great Resignation in the US. And now the lying flat movement in China is quite bad, right? Apparently, according to some of the influencers that's gone to China. And the young people feel that, it's really no point, slaving for another company, 996 kind of lifestyle, when they can just chill and just go through life in a more relaxed kind of manner, right? And you find that it's particularly bad at places like China right now, okay? And but you can feel it, right? In Singapore, I mean, if there's really nothing to look forward to, then why not just take life easy, right? I'm sure a lot of you guys think that way, right? So that's why some of you guys are looking at investing to improve your kind of lifestyle, right? And of course, at the same time, in summer, you've got a problem, right? Because financial institutions want to take control over your investment strategy. So they've got a motivated pool of supporters who make commission from these sales. And so once you graduate from university and summer begins, you get phone calls from your friends who became financial advisors, and they catch up with you to sell you ILPs and all sorts of toxic investment products, right? And it's very annoying, right? It's very annoying. And it got so bad that I have friends who call up their friend asking for an outing in good faith. And the friend actually tell them that, hey, if you're selling insurance, I don't want to meet up with you. Yeah. Okay. Yeah. So it's that bad in Singapore. And of course, the moment you go to work, right, your knowledge isn't that valuable anymore with things like ChatGPT and large language models. So your skill set tends to be spiraling downwards. But at the same time, the mortgages that you're getting yourself into when you buy a house can still take many years to pay up, right? So you don't have much time to earn your keep in a modern economy because your skills is also depreciating very quickly, right? Yeah. So I think that's fundamentally a very serious problem that Gen Z and millennials have, because their degrees are just not retaining their value as much as my generation when we started out, right? So you earn the most money at this peak of your time. If you spend too much time indulging in your lives, right, you will pay the price later on, right? Because slight mistake, right? You get retrenched from a technology job. You can't get another job because artificial intelligence has taken over some of the work that you have. You're going to be in serious trouble, right? Yeah. So one of the myths that financial advisors like to spread is that retirement is impossible unless you listen to them, right? And let me just try to bust that myth, right? And before I do that, I need to walk you guys through what retirement really means, right? What kind of assumptions do we need to know when we're talking about retirement, right? So this way you'll be enlightened on actually how to work out your own retirement. Okay. So why do you need $500,000 to retire, right? The answer is yeah, you do need about $500,000. And the reason is because in 2021, academics found that a single person at the age of 55 would need $1,768 a month to lead a dignified kind of existence. So 1,768 times 12, which is how much you need a year. And we divide it by 4%, 0.04. Where does this 4% come from? It comes from this idea that a millionaire in the stock markets can spend $40,000 every year and not run out of money for the next 35 years, right? Because you can actually spend the earnings that you have for the financial markets, right? So that's called the safe rate of withdrawal, right? And if you were to crunch the numbers, you end up with a number very similar to 500,000, about 530,000, all right? So to play safe, you might need about 600,000, all right? But 500,000 is not too bad, right? If you're gunning to get out of the rat race early, and if the sums don't include CPF, you'll be just right, all right? You'll be just right. Okay, now the second thing you need to realize that because the way our corporate world is structured, right, you don't really have a lot of time to get ready, okay? So a person who has served 4 years, who spent 4 years getting a degree and served NS will get his first paycheck at the age of 25. But he doesn't actually settle down immediately, right? You job hop a little bit, you pick up some skills, and you settle down on a career much later, especially if it involves an advanced degree, right? So you start making real money only at the age of 30. A lot of people only become an adult at the age of 30 these days, right? It's a function of advanced societies where adulthood becomes delayed. All right, it's something that sociologists do talk about. Okay, and then if you look at the people who are getting retrenched, the tech workers getting retrenched are in their 40s, right? Their 40s, and some are getting retrenched as early as 35 in China, right? But you find that maybe these technology professionals are working on a technology that's no longer relevant. Like if you're working on an electric car for Apple Computer, right? You're out of a job when they decide not to carry on with the kind of R&D for the car division, right? So it becomes very dangerous when you hit around 40 years old because then you go through this process where you get retrenched and then you have to reskill under the government skills futures framework and then you get re-employed, the 3 Rs, right? And that goes on and on until the end of your life. And it's quite bitter, right? It's quite bitter to go through the mental anguish of getting retrenched because I got friends in their 50s, my classmates who are going through that same process right now. They're very highly paid, but they're retrenched in their 40s, right? So if you were to align everything on the timeline, you realize that you don't have a lot of time to actually plan for retirement. You have maybe 10 years plus or minus 5 years, right? To actually do proper planning. The reason is because if you put everything in the timeline, this is the shelf life of a degree, you know? And so 10 years is basically it, right? So you're under a lot of stress to plan for retirement, and the retirement threshold of $500,000 is not easy to accumulate within 10 years, right? And of course, the third assumption is, let's look at an example of an average Singaporean. How much does he earn, right? And if you adjust the salary based on inflation from my 2020 numbers, the person can save $2,000 per month of his take-home pay, all right? So if you look at the numbers, yeah, the median Singaporean can save $2,000 a month on his take-home pay, and he's likely to be able to struggle to plan for retirement in this way. All right, so these 3 assumptions, we can get to work, right? We can start analyzing to find out whether what insurance agents sell to us or bankers, whether their plans actually work. All right, so let's look at some insurance products. Now, suppose you have a short-term endowment and it gives 2%, right? And I want to use this as a retirement instrument. I set aside $2,000 every month. How long will it take for me to reach $500,000? Right. So that's the first question I want to ask you. And to answer that question, we use a compound interest calculator. And this is what we do. We fill out how much our contributions are annually, 24,000 a year, the interest rate or the return from the short-term endowment fund. And then we keep increasing the number of years, right? Year by year, until the future value hits $500,000, right? So that's how we use a compound interest calculator to figure out how many years it takes, right, in order to reach financial independence, right? And so in this example, it takes 18 years to meet your objective. 18, 1-8, right? Okay, so let's put this on this column. A short-term endowment that gives you 2% give you 18 years, right? Then what about a long-term endowment? A long-term endowment can pay up to 4.25%. That's the maximum allowed under the benefits illustration, right? And when you do that, going through the same process, it take you about 15 years to get out of the rat race. And if you buy a financial weapon of mass destruction, otherwise known as an investment-linked policy, and investment-linked policies are very difficult to read, right? Because most of the money goes into the insurance component compared to the investment component, right? And they're not really designed to give you a high return because of all these administrative fees that they levy on you. So I've been very generous, all right? I've made the assumption that they could give you 5% every year throughout the lifetime, which is very hard to achieve, right? And with 5%, you still get out the rat race within 14 years, all right? So anything that the financial advisor can offer to you generally will not allow you to meet this retirement goal, an aggressive retirement goal of 10 years, right? Mathematically impossible. You can perform your analysis using a compound interest calculator on your own, all right? Then let's look at what unit trust platforms, right, sold by relationship bankers, private bankers, what they can do for you, right? I've given them a more generous return, but actually it's almost the same because of platform fees, very expensive trailer fees that they kick back to the person that's selling the product, right? So when you do this, right, at 6.5%, you still take 13 years, all right? And so as a general reminder to the people listening to me that we pay a lot more for our unit trust compared to people from the rest of the world because of this thing called a trailer fee, all right? And you need to be very insistent and stubborn when challenging a financial advisor to work out all the expenses that is levied by the fund on an annual basis, all right? If you don't do that, you're going to be on the losing end, okay? All right, so what does it mean? Now, it means that if you were to listen to a sales professional, you're going to fail, right? You surrender the control of your financial destiny to someone else, you're going to do badly. You're going to do badly in life, okay? And the reason why is because you're trying to save money and retire early, and so does the person trying to sell the product to you. So there is a conflict of interest, right? There is a conflict of interest. And unless you solve the problem of the conflict of interest, you're never going to win, right? Yeah, and so that leads me to the next section, where I'll talk a little bit about what if I decide not to listen to a financial advisor at all, and I engage myself in DIY investing, right? And that's exactly what we're going to do, okay? Now, a little bit reminder of some of the dangers that you're going to meet in the industry is that very often some financial advisor, the smarter ones, will try to sell you an investment product that is based on thematic investing. That means I sell you something based on maybe China in the past and currently Indian markets, or something that is technology driven because they've got very good recent results. And then they try to bait you using superior returns, right? But unfortunately, these superior returns do come with a higher risk that is generally not shared with the person that they're trying to sell it to. The risk is not shared. In other words, ask them a question: what is the standard deviation of the performance of the fund, right? They might not be able to answer it for you, right? And when you do that and the fund readjusts in value, reverts to the mean, you can end up with losses within the short term after you buy the fund, right? So that's the experience of a lot of Singaporean investors, right? To show you how important risk is, right? I'm just going to stop my share now and let me demonstrate a little bit of my investment, my coding capabilities. All right, so I sometimes write computer programs to demonstrate some investment concepts. And what I have here is a simulation of 500 retirement portfolios with the same return and standard deviation, right? The same risk and the same returns. And there is always a failure rate. 10% of these people don't make it. They don't make it at the end of their life. All right. Now, let's see what happens if I can find an investment that actually produces higher returns, right? If I do that, then obviously the failure rate goes down, right? The higher the return, the better the outcome, right? Yeah, but what if keeping the return consistent, I increase the underlying risk, right? I increase the underlying risk, and you find that what will happen is that the failure rate can increase even when your return remains the same, right? So therein lies the moral, right? When we make an investment, we can't just have a discussion about returns, right? And a lot of people like to share these very pornographic returns, like we've returned like 15% for the past 5 years. And then they tell you past performance does not mean future performance, right? I mean, that's how they protect themselves, right? But you've bought the fund, you've paid the commission fees, right? And that's bad for you. Now, why Singapore stocks? All right. Singapore overtakes Thailand to become the worst stock market in the year 2020. And we've got a very bad run in Singapore because REITs have been doing very badly. Okay, but why do I like to use Singapore stocks as an example? Is that there are no capital gains or dividend taxes. So you have an advantage. You don't pay money to Donald Trump, right? You don't have to pay the 30% withholding tax when you buy an American stock. And there are no problems with estate planning if anything happens to you because Singapore has very liberal inheritance tax rules, right? So that's the reason why I like Singapore. And on the third reason, which I don't put on the slide, is that our price earnings ratio is very low right now, right? It is, I think, less than 10, right? If it's higher than 10, it's definitely less than 11, right? So it's very cheap right now to get into Singapore stocks, right? And let's talk about our first strategy, right? The rookie strategy is I buy the STI ETF, right? I put my money into this thing called the Straits Times Index Exchange Traded Fund. And when I put my money in, it's automatically distributed between all these big Temasek-like blue chips. You've got 3 banks, 7 real estate investment trusts, companies like SIA, ST Engineering, Venture Manufacturing, right? So the idea is that if I buy this, I would be able to just not think about my investments anymore and rely on the Singapore economy to get where I want to go in the future. All right. So that's one way of designing a rookie strategy. All right. However, if you have done this for the past 16 years up to January this year, you would have earned only 0.6%. And if you do this over a long period of time and you want to plan for retirement, you need 20 years in order to be able to get out of the rat race. All right. It takes a very long time to do something like this. All right. Because of this, the Singapore stock market, there are now murmurings about what we can do to make our stock markets be more vibrant. Right. This is the reason why, right? 16 years, 0.6%. Okay. All right. So the rookie strategy doesn't work. Now, why does it not work? Now, the problem is that the ETF is capitalization weighted. 45% of your funds are actually distributed between DBS, OCBC, and UOB. And when the banks go through a period of very low interest rates, like in the past 10 years, right, they will tend to underperform, right? And so this is the weakness that we want to be able to deal with, right? So how do we deal with this problem of capitalization weighting? We take our money, for example, if you have $300,000, we divide it equally into 30 parts and we allocate it to these index component stocks, right? So for example, Jardine Cycle and Carriage, I put 10,000, DBS, I put 10,000, Campbell Corp, I put 10,000, and so on and so forth, all 30 stocks. Now, if you do this, you no longer have too much of your money focused on banks, and the money is evenly distributed between all these local stocks. And let's see what happens. For the same period of time, you find that your performance improves to about 4.5%, right? So buying equal weighted STI counters actually do matter. And this is something that's reported in many other markets. You can do the same with the Standard & Poor's 500 by buying the stocks in equal shares or looking for an ETF that buys them in equal shares. And you can end up with slightly better performance, right? And by doing this, you've sort of cut down the time you need to retire to 15 years. So from 20 years to 15 years, significant kind of improvement, right? And of course, you say that, well, maybe I don't buy all 30 stocks. I look for 15 stocks that may give me a better chance of outperformance. So how do I do this, right? So we do this by factor selection. You pick 15 stocks that has a lower price to earnings ratio or higher dividend yield, right? And you look at your performance after that, right? How to do this mechanically is you turn to the newspapers. The weekday copy has a table that looks like this, but it doesn't have so much color. You take the dividend yield column and you pick 15 stocks with the highest dividend yield, all right? And then after that, you divide your money into 15 parts and you buy them all in equal shares, right? In equal weights, right? And if you do that, your performance improves again from 4.5 to 5.4%, right? Dividends have gone through a very bad time. That's why the number is low. The number tends to be actually higher than 5.4, right? For a long time, the number is between 6 to 8, right? Okay, so the risk has gone up slightly, but you're getting about 5% returns. And if you put it in a compound interest calculator, you're getting something superior to what many financial advisors can give you, all right? And you find that you can get out of the rat race after 14 years, which is not too bad already. Not too bad already, okay? And of course, the next thing you want to do is, can we apply more factors to this dividend kind of formula? And there is computer software that I teach that would actually allow a person to do that, all right? You can actually apply a superior kind of result to get a better result mathematically, okay? And if you shortlist 8 stocks with the highest dividend yield, low price to earnings ratio, low price to book ratio, and the highest profit margins, these are all accounting variables that a computer software can automatically calculate for you. And if you're able to do that, you can increase your returns further to 10.2%, right? At 10.2%, the risk goes up slightly, but the important thing is that now your retirement plan can be complete within 11.1 years, right? Which is actually as good as it gets, right? But you might say, Chris, I still can't get this within 10 years, right? I might still, be experiencing a little bit of career risk at the end of it, right? One way is to just accept the career risk. But if you say that my career risk is too high, I'm willing to take on a little bit more market risk, then what you can do is that some brokers allow you to borrow money from them at a borrowing cost of about 4.8%. Okay, so if I can borrow at 5%, and for every dollar I have, I can borrow another dollar, right? I can actually have a larger portfolio. In fact, the portfolio is twice the size of what the amount of money that I put in. And if you do this, your return can go up from 10.2% to about 15.5%. All right, so that's a very, very nice kind of improvement to the results. Okay, and if you use the same formula just now, 8 stocks with the highest dividend yield, lowest price to earnings ratio, low price to book ratio, and high profit margins, right? At 15.5%, right? But of course, your risk goes up by a lot, right? At 15.5%, you're able to actually get out of the rat race within 10 years, all right? But you're taking a little bit more risk than other people. And right now, while interest rates are high, I don't recommend that my students do this. But you might want to learn how this works so that when interest rates drop in the future, like maybe at the end of 2025, you can go into a leverage portfolio again. All right. Okay, and so the summer tip that I have for you is that retirement is possible, but you must be willing to level up your investment knowledge. You can't outsource it to somebody else. You develop the skills, you come up with more and more sophisticated investment models to improve your investment performance, right? Remember that we started out with the STI ETF, the performance was very humble at 0.6. Then when we equal weighted, it became 4.5. When we started to pick a dividend-based strategy, it gave a performance of 5.4. When we refined the dividend strategy with other variables, we could get double digits, right? And finally, we can borrow money from the broker to actually get a return of 15.4%, right? All this can only happen if you become smarter, right? You invest in your brain, right? You invest in your brain. Okay, and so summer is really about, you've gone through spring, and you've gotten some working experience, what can you do to apply your knowledge to gain an edge in this world, right? To get more money or to get more power. And summer is all about growth, right? In fact, it's the only season where you can grow exponentially, right? And so that concludes our discussion about summer. The third season that I want to talk about is a season of autumn. And this is where your life begins to slow down, your happiness reaches an all-time low. I made a series of career mistakes after my daughter was born to jump to a statutory board to get more work-life balance. But as it turns out that I worked in a very toxic kind of work environment where it was very elitist and very driven by their blue-eyed boys and their scholars. So I remember getting into an argument with a senior director over a technical issue that I'm familiar with. And this is a purely technical discussion. It's not about policy, right? The technical discussion is about a programming language where I claim that I could issue one prompt command and you generate a website for me with a functional database, some business logic, and a front end. And the director didn't believe that was possible, and we got into a fight. I'm not willing to let go if it is a technical question, right? Because I can't afford to have senior management in a statutory board be unenlightened about technical matters, right? Yeah, so we clashed and he couldn't beat me. So he called a scholar in to thumb me down and he said, who's right, me or Chris? You got to understand the senior director is 4 ranks higher than me, okay? And the scholar can just throw me under the bus, all right? I'm a mid-career hire and obviously I don't have a lot of emotional intelligence, all right? So here's the funny thing. Instead of throwing me under the bus, the scholar said, I can program too. Chris is right. Yeah. So with a simple gesture, the scholar helped me win the argument, right? And you thought that the unreasonable director would go after the scholar next, but that's not what actually happened, right? They love scholars so much, they are afraid of scholars leaving the organization. So he said that, okay, if you say that Chris is right, Chris, you win, you can do whatever you want, right? But I was really angry, right? I had working experience for 14 years. When I make an assertion on a technical matter, I actually do these things. Unlike many other government people, I actually code, right? And you find that in all my investment courses, there's always something to do with coding lah. And given that I'm now a lawyer, there's always something involving actual high court cases, right? Yeah. And yeah. And I was so angry, all right? I knew that the organization was not the right one for me. But a couple of months later, and I work in a very toxic workplace, there are these glass panels where they get these hapless government executives to go into the glass panel to get shouted at, right, by a supervisor. So my turn came, I got brought into a room and this supervisor started to shout at me at the top of her voice. And I didn't even know what went wrong. And after consulting her, I felt that she was unhappy because I launched a project without her permission. But there really isn't any rule for starting work for ministry, you see, because the paperwork doesn't exist for other projects as well. So I asked her to help me find the document to make it work so that she can approve the project, because we shouldn't slow down what the customer wants to do, right? Yeah. And instead of helping me solve the problem, she shouted at me even harder. And so I lost my temper. And that was what broke the camel's back, right? I told her, fuck this shit, I resign, you know? And yeah, and that was basically the end of my career. That was over a decade ago. And I never drew like a fixed kind of salary ever since, right? I've always been some kind of a freelancer, someone running my own business, my own product line, right? And how was that possible? Right. So these are my family expenses. I have a wife and kid by now. This is my salary. And the amazing thing is that the dividends is actually higher than both. So I could actually resign from a toxic workplace and not participate, right, in this kind of rigmarole, right? I don't need to deal with any of these shenanigans, right? And I can leave, right? I can leave. I can leave the organization. And HR was particularly afraid when I said that. They asked me where I'm going. I said I'm retiring, right? Yeah. And they should be afraid because the next thing I did was that I signed up for law school, right? I sent an application to SMU as an IT professional. My first degree is in engineering, so I decided that, I needed some skills that deal with what they call structured ambiguous problems. So I spent the next 3 years studying with kids half my age to get a Juris Doctor at the end of the 3-year program. And I got called to the bar in 2018 after going through Part D, right? And of course, the next question is, what are you doing here? Why are you teaching investing? The problem is this, right? When you go through your autumn, your attempts to reinvent yourself are not going to be successful. And that is the experience I had, right? I failed to transition into the public sector, into a statutory board from the private sector, right? And then after that, I tried to reinvent myself as a lawyer, and that failed really badly because I hated criminal work, I hated divorce work, and because of my age, there's a lot of ageism. I couldn't get the kind of corporate work that I desire, sales and purchase agreements, looking at contracts, Securities and Futures Act kind of work. I couldn't get the kind of work, right? Yeah, and so I think that is a very important lesson in autumn, in that things may not work out, right? And things are very unpredictable. And I was just lucky that I was able to fall back on a dividend strategy. And I'm going to talk a little bit more about what I did to my dividend strategy. All right. So during my years in SMU, I didn't study law as hard as my classmates. All right. I didn't have to, but I did spend a lot of time with the Bloomberg terminals there to refine a trading system, right? And on top of it, to increase the amount of dividends I have, right, I borrowed money from a broker and I applied leverage on a local stock portfolio. And that is very important because I have a problem that a lot of people who study an advanced degree have, right? The model that we have when we study for an MBA is that I have a pile of savings and then I pay for my school fees. And at school, I use up my savings. And at the end of the course, I graduate and I start work. But I start work with a very low net worth. Okay. So my approach was different. I had dividends coming in. I leveraged to get more dividends. Then I had enough money to pay my school fees, support my wife who doesn't work, support my children. I even had a kid during law school. And I was able to pay for my mortgage payments for my executive condo, right? At the end of my law school experience, my net worth was actually higher. My net worth was higher because I was able to farm back my dividends to make my portfolio bigger, right? Yeah, and more importantly, I was able to sleep well at night, right? And that's really a luxury for people who are going through autumn, okay? So for your autumn, you're likely facing higher cost of living, right? Which is why our inflation numbers, it's gone up, then it's gone down slightly. It's about 2-point-something% now, right? GST is already 9%. And the war in Israel and the war in the Ukraine has been carrying on, right? Has been carrying on, okay? And things are going to become more and more expensive. And this is a problem that the rest of the world is facing right now, okay? And of course, in autumn, your job search is going to be harder if you get retrenched, right? You need to deal with a severe pay cut, and you may have to join an organization that's a lot more toxic than the last one you're in, right? It's almost like, looking for a Tinder date in your 40s is very different from looking for a Tinder date in your 20s. There's also ageism and jobs discrimination in Singapore that people are trying to address right now. And if you look at the kind of premium that people pay for your working experience, they are willing to pay 5% more every year until you hit 45 years old. And then after that, it mysteriously goes flat, right? Yeah, because a lot of people lose their director level jobs and they end up driving Grab. That is a very real kind of, that's the kind of reality that a lot of people face. Okay, and finally, we are also part of the sandwich class, right? We have to support, our parents, then we got to support our children, right? In 2020, Sengkang fell to the opposition because of this, because of people in my generation who are sort of frustrated and feeling a lot of economic pain, right? That's why as we come onto the next election, you'll find that there's a lot of welfare-like kind of policies surrounding skills futures, right? You're likely to see that if you're Singaporean. So autumn, you're no longer at your earning peak, you're facing retrenchment in the workplace, all right? You're at a very dark place, right? I'm at a very dark place, right? I'm at a very dark place. So investing, the myth in autumn is that some people tell you that, investing is very complicated. It can distract you from the realities of life. Sometimes they even tell you that you don't have any more time, right? You don't have any more time to actually start investing, okay? And I think sometimes they have a point, right? You look at this investment called Sabana Industrial REIT. I really like this REIT a lot, even though majority of you may not actually like it as much as I do. Okay, it's one of those REITs that collect rents in Singapore dollars, and it gives you a 7% dividend every year. All right. But unfortunately, because we've recently voted to scrap their manager to make way for an internalized team, investors have suffered, right? We have to go through more EGMs in the internalization process, okay? And if we can succeed, and it's not easy to succeed, right? We'll be the only REIT with an internal manager moving forward, okay? But at the moment, things look very gloomy and complicated with this REIT, okay? Yeah. And what can we do, right? Yeah. But I think that sometimes, at least if you are a local investor, don't think too hard, right? All you need to think about are the kind of dividends that you're going to get. We play safe. Now, what you do is that you look for blue chips. You look for the large REITs, the large blue chips that can give you 5% dividend. All right. It's not difficult to find them on the newspapers today. All right. You can do that on your own. Okay. Now, if you can get 5% dividends, you shouldn't be aiming for financial independence immediately because it will be too stressful for you. I suggest you aim for $100 every month. All right. 100 multiplied by 12 divided by 0.05 is $24,000. So if you set aside $24,000, you will, in essence, get your first golden goose that lays $100 of golden eggs, right? And you can get a golden goose by setting aside $2,000 every month within a year, right? And this $100, don't laugh at it. It's not a lot of money, but you could get a Netflix account subscription paid. You can pay for a Disney Plus account and an Amazon Prime account, right? So it's actually a very good deal, right? You can improve the quality of your life with this $100, and it's going to recur every month, right? It's going to recur every month, right? Even though it pays a quarter, like $300 every quarter, it will keep recurring. And the trick is, if you're able to get your first golden goose, your second golden goose is going to be a lot easier because you got an additional $100 from your first golden goose, right? And so on and so forth. You can use the power of compound interest to build a flock of golden geese that would be able to fly you and take you out for the comfort of gravity, all right? So this is how you get out from the rat race, right? You get your first golden goose that is achievable with $2,000 saved every month, lays $100 of passive income as golden eggs, right? Autumn, it's about taking stock, about developing resilience in your life. Not everybody is going to become financially independent, but I believe that everybody listening to me have the power to get one golden goose that lays $100 of golden eggs, all right? And that would improve the resilience of your life. So with that, we've come to winter, which is our final season. You get to enjoy the fruits of your labor and your happiness goes up again, right? For my life so far, I'm not going through winter yet. I'm only reaching my 50s at the end of the year, right? My life has the usual amount of travel with my family. I have slightly less travel because I don't enjoy it as much as I think many of you, right? But I prefer to focus on simple living, right? And so here are two examples of what financial independence can mean for you. The first is my son, Durando. I take him to school and I bring him back from school every day. We've developed a closer bond and I play with him. And so the relationship between me and my son is actually slightly better than my daughter because my daughter was, when she was in kindergarten, I was working, right? And so you develop a closer bond with your children. And 5 years ago, I lost my dad in his final months in the hospital. I was able to visit him every other day, find out about his condition from the doctors working the shifts, right? I was able to get an update, right? And that's very important because these are the final months where you can be with a loved one, right? And that's what financial independence can give to you also, right? And of course, as you hit your 65, your winter, your expenses will change, right? Your overall expenses will drop, but you spend more money on home cooking, furnishings, and your medical expenses will go up by a lot, right? We are facing longevity risk, right? Singaporeans are living up to the age of 85, but you're healthy up to the age of 72. So you're living for too long, and there's this 10-year gap where you'll be suffering from a particular illness. So very tough longevity risk. Okay, and the most important slide of this section is that all of us face the problem of retirement inadequacy. If you have the full retirement sum of $200,000 in your CPF life, you would get $1,150 in today's money, right? In today's money, based on the standard plan, based on the plan that gives you the highest, right? So there is a gap because the Lee Kuan Yew School says that you need 1,004 to attain a basic standard of living, right? So there is a $400 gap that you will need to fill anyway, right? Even if you're a good soldier and you follow what CPF says, right? So if you can collect 4 golden goose or 5 golden goose, that would be nice to cope with this retirement adequacy, right? So what happens in winter? Well, depends on how well you play the previous stages in your life, right? You sort of reap what you sow in winter. And one of the myths in winter is market crashes can destroy your life, right? Especially the older investors, they put a premium on stability. They want to know what they can do when markets are crashing. So in the Great Recession of 2009, I was just working in a financial exchange. I was farming most of my income into the stock markets. And I was losing money every month, and people were making fun of me, right? I told them that I've lost the BMW to the stock market easily, right? COE, everything. And they were laughing at me because they are not invested at all, right? Because they are smart Ivy League people, they don't need to invest, they can just rely on their careers, right? But I knew something that they don't. I knew that if you were to tabulate the market crashes, for all the crashes for the past 30 years, right, you find that the longest top to the bottom, right, markets began to rebound within 700 days in the Asian currency crisis, which meant that for any sort of downturn that we experience in the future, right, it's going to last shorter than 2 years. That means if I face a market crash, I carry on saving, I carry on investing for 2 years, I will make a lot of money when the market recovers. So that was the lesson that we learned, right, from tabulating all this data. And when the markets recovered, I told my friends, I said the Porsche, the BMW I lost in the stock market came back as a Maserati, right? Yeah, so if you look at December 2008 and the real estate investment trust that we had, it's not very different from the period that we're going through right now, except that the yields were very high, right? Double-digit yields for even well-established brands like Escort, for Mapletree, and you're getting like 15%. So obviously that was what made me a millionaire, right? I invested throughout one of the worst market crashes within my lifetime, and I emerged with a net worth of 7 digits, right? Now, markets are a lot more attractive right now. If you go through the tables and you look for current yields, you can see occasionally a few real estate investment trusts giving about double-digit kind of dividends, okay? And interest rates stay flat for the next few months. You know, you present a very good bargain hunting opportunity for many investors. And this is how millionaires, it's going to be made in the year 2025, 2026, all right? And there's even more good news today, right? If you read the newspapers today, there are now very serious proposals on how to revive the stock market, right? Are we going to channel part of the private equity monies coming into our stock markets, make it compulsory when they set up their family offices here? Are we going to allow more money from CPF to be invested in it, right? So there are many of these proposals, and my belief is that you can't do it with one proposal. You need 3 or 4 different proposals happening at the same time for markets to go back to fair valuation. I'm not even talking about high valuation, all right? Singapore probably wouldn't achieve high valuation, but from a price earnings ratio of 10 to 11, going up to 14 is a very reasonable kind of target, right? And if it goes up to 14, you could be looking at a 30 to 40% increase in the value of your Singapore stock investments, right? Yeah. Okay, so the tip in winter is market crashes are your ally in building great wealth. Don't be afraid of it. It's often what separates the boys from the men, okay, and how millionaires are made. All right, and winter is about enjoying what you have and cherishing your time. All right, yeah. So not too much work should be done in winter because it's really the time for you to enjoy your kids and enjoy the relationships that you have. All right. Okay, so basically this evening, I've spent some time talking about 4 seasonal truths to counter 4 myths, right? Your X factor can come from reading popular finance books. That's a myth, right? You need to invest the time to learn finance the hard way, right? You cannot go with the smooth, like Robert Kiyosaki kind of books that motivate you. You need to read books that tell you actually how to invest, right? You need someone to guide you along if there's a need to, right? Retirement is impossible unless you listen to an advisor. Actually, if you listen to an advisor, your retirement is probably hobbled, right? Retirement is possible if you're willing to level up your investment knowledge, pick up the skills, and make sure that you're better than your investment advisor, right? Thirdly, investing is too complicated, can distract you from the realities of life. No, get your first golden goose, right? There is time, okay? Get your first golden goose in autumn and let it change your life, right? Even if you might not become financially independent, $100 every month recurring is a very good idea, right? And finally, market crashes can destroy your life, nothing to be afraid of, right? Market crashes are your ally in building great wealth. We can get a lot more golden goose when there's a market crash going on at the same time. Now, what am I really driving at after spending the bulk of an hour talking to you? It's that actually, the conventional definition of the Singapore dream is dead, right? I mean, we are all taught to study hard, go to school, get good grades for PSLE, move on to go to a university to get a professional degree, and then get a good honors classification so that we can convert it to a steady job with a multinational. And then we work your way up, accumulate the 5 Cs in the process. And when your CPF life comes online, you retire at the age of 65, right? There's so many problems with this idea, right? You go to school is very competitive these days, right? As any parent who's gone through PSLE will tell you, right? And getting a professional degree doesn't mean a lot if your knowledge becomes less valuable in 5 years, right? There is no such thing as a steady job, right? There's no such thing as corporate loyalty. Companies will not be loyal to you, right? And so you have to make a lot of lateral moves rather than working your way up, right? And the 5 Cs have become less meaningful. Who needs a country club? Who needs a credit card, right? Yeah, and CPF Life, I've worked with you the inadequacies of CPF Life for many of us, right? So what is the new Singapore dream, right? I have to offer you an alternative. So instead of the 5 Cs, I offer you 1D, okay? This is what dividends can do for you. Support your children's education, help them focus on the paper chase when they are going through spring. In your summer, ease minor expenses, smooth out all these lumpy salaries while you settle down in the corporate workforce. In autumn, deal with children's education, parents' medical expenses, cope with retrenchment and facilitate career pivots. You're going to be retrenched once or twice in your life. Hedge longevity risk, pay for medical expenses, prevent yourself from becoming a burden to your children. Dividends is money, right? When you say, show me the money, this is how the money will arrive on your bank account, right? This is the most powerful evidence of what dividends can do for an investor when you see money flowing in from the CEP. All right. Now, if you do this golden goose thing for like 1.5 decades, right? These are my results in the second half of the pandemic year 2020. And I was getting about $80,000 during the 6 months, averages to about 13,000 every month. The yield is about 6.6%. So this is a dividends-based kind of portfolio, right? When the slide was created, the median household income then was $7,700, and a $2.4 million condo in Shenton Way rents for about $5,500 to $6,000. So you can compare the idea of a blue chip dividend kind of portfolio with a sprinkling of REITs and business trusts. You can compare it with actually owning a home and renting it out, right? Characteristics are very different. Obviously, it's good to have both, right? Okay, and we've come to the end of the first part of our workshop, all right? And we will take a 5-minute break. The time is 8:35. At 8:40, right? 8:40, I'll come back and we'll talk about the early retirement masterclass. All right, I'll see you at 8:40. Okay, thank you for staying back. All right, welcome back. I'm going to spend a little bit of time talking about what is the Early Retirement Masterclass. This is going to be a 5-day course to help us recapture the Singapore dream. All right. The first objective is to allow you to transition into an independent and successful DIY investor with support from a community of like-minded investors. All right. Secondly, to create a secondary source of income that will meet your lifestyle needs, all right, and gain the ability to use a data-driven framework to grow your portfolio in ever-changing market conditions, all right? So these are the three things that we strive to do, all right? And what kind of outcome do we really want, right? We want a portfolio of local stocks, 15 to 20 in number. It has to contain blue chips, real estate investment trusts, and business trusts. It is then designed to provide about 5 to 6% dividend spread across the year and consistent with our view of the market cycle, right? So, and then you build once and you leave it for at least a year. You don't touch it for 1 year. So it's like a cactus plant, right? You don't need to water it every week in order for it to grow. All right. So how do we prepare our students, right? We have 4 days of online training like this. It lasts from about 7:30 in the evenings to about 10:30 at night. And then on the Saturday, we meet up face to face. I will divide some work between students and we begin to do research on some screen stocks, all right? And after you do the research, you have a discussion and debate within your team, and then you decide what stocks pass. It's like getting the stocks to go through Shark Tank, okay? And the stocks that pass, your discussion will then be added to a portfolio, all right? So that's how we prepare our students, and students become financial analysts for a day, right? And this is a solid course that actually has some finance theory. There are just some of these sample slides. You'll be given enough training to sort of understand what goes on in the world of finance, all right? So, so it's a very good way of for professionals to sort of remember what is taught in school and how to relate it into the idea of making money, right, in modern society, right? Okay, so what's special and our unique selling proposition is that we have a bespoke tool to turn a class into a room full of investment analysts. So this is the ERM data entry tool that I wrote, all right, using Python Django, and I will run it during the program, and it will collect data input from various investment teams. And after we collect the data input, it can generate portfolio statistics on your own. So that's how you can turn a class, right, into people who are almost like semi-professionals, okay? And we will participate in 2 rounds of portfolio creation, and there'll be a lot of lively debates, okay? And this will result in a portfolio that can be executed within the markets. So here's an example of what happened in July 2021, where we built a portfolio about, I think, 17 blue chip stocks, and the average yield that time was 5%, okay? And my software is able to generate all these statistics for you to understand a little bit about the software. Like for example, what can you possibly lose? What's the maximum drawdown? You automatically calculate that for you, right? Okay, now every investment decision in our class is captured and contained in the document that will be sent to the students. And this is to make sure that when you attend the course, right, the material that explains the investment decision is generally better than what is reported by many fund managers out there, right? Even the active fund managers or your financial advisor, they won't be able to do something like this, right? And the final outcome is a PDF that everybody will receive that can be executed the following Monday, right? In the course, we will teach you how to fish. Many students, however, will say, Chris, I don't want to learn how to fish. I just want to eat the fish. Can you do that for me? I say, yes, I can do that for you. All right, you will also be supplied for you at the end of the program, right? A sample 17% return strategy can actually get you to retire in 10 years without the use of leverage, right? Without the use of leverage, right? It can also produce a yield of 5%, but obviously the return back tests vary from class to class, all right? You cannot guarantee that you will get the same kind of performance, right, for the next run of the program, okay? So here's a reminder of what we're trying to build, right? We're trying to build a dividends kind of portfolio, and the dividend is denominated in Singapore dollars, and it comes in tax-free, all right? If 30% of your money is kept in CPF Life and you're a millionaire, right? 30% in CPF Life, $300,000 in CPF Life will get you about $1,600 every month, but that amount is fixed. it is unable to fight inflation because it's under the standard plan. But if you have $700,000 in dividend stocks yielding 5%, you make an extra $2,916 every month. And generally, these investments can fight inflation. Your dividends likely to go up with the inflation rate, right, over the long term. So you've got the best of both worlds, right? A guaranteed amount and an amount that sort of grows with inflation but can fluctuate. But collectively, you get about $4,500 of passive income every month, right? Which you can then use to support your retirement kind of lifestyle. So this is how the portfolio that you'll be building in my class can complement CPF Life, and then it can also deal with all these changes in budget 2024, like the CPF special account disappearing, right? The relationship continues after the course. Students are all inducted into the Early Retirement Masterclass Facebook group. There are 700 over alumni that can assist with Q&A, and there's lifetime access to the portfolios built by subsequent batches of students. So you attend the course in June, you receive the PDF. In September, when I run a new course with a new batch of students, you will also receive the decision-making of that batch of students, all right? So no monthly membership, no upsell of advanced courses, lifetime support, right? Lifetime access to portfolios, provided I continue to run ERM. If ERM shuts down, then obviously there'll be no more further support, right? So, so far I have run 33 batches of students, 33 batches of students. We've graduated 700 students. I've been doing this close to 5 years, right? I've been doing this for 5 years. So I've been running for a very long time. Okay, I'm going to spend some time explaining why I can eliminate the conflict of interest that I've been talking about earlier, right? I operate very differently from other investment trainers because I'm financially independent. I live on my dividends. And my dividends has been supporting me for the past, since I was 39 years old, 11 years, right? 11 years, okay? So what I do is that I will invest part of my course fees into the portfolio that the class has made, all right? So this way, if the class were to lose money in a fluctuation, the guarantee is that the instructor will also lose money. Now, why is this important? It guarantees that I'll try my best to teach you the best stuff to help you make the best decisions when we build the portfolio together. So that's the guarantee, because I'll be the first person to suffer if the portfolio doesn't do well, all right? And I think this is something that actually should be appreciated a lot more, I think, in Singapore, because it's very rare for some kind of an investment instructor to teach his students, then have his students build a portfolio, and then I invest in what the student has built, right? But this is a way of saying that I have skin in the game and I'm doing my best, right? I'm trying my best, okay? Because of this, I need you to be able to make good decisions with your own money as well, all right? So the capital required to benefit from this class, and it's capital that you manage on your own, I'm not asking you for money, right? It's $10,000, right? If you have $10,000 in your CPF account, $10,000 in your SRS account or cash, that's fine, right? Because if you buy an investment course, you should have a reasonable probability of earning money from that cover your fees, all right? Okay, now if you don't have $10,000, then at least have an income of at least $3,000 a month, right? Then this way you can slowly build up your golden goose over the next 1 year, right? I need you to be IT literate, right? You need to operate a laptop and a mobile phone. You sort of need to understand what it's like to sign up, for example, for a website, right? I mean, you attempt to send you an email, the email might end up in your spam folder. You also need to understand basics, like sometimes when you use a browser, it might block a pop-up, notice, right? So that kind of IT literacy is useful because I don't have a lot of time to help you go through these basics, right? And of course, there is some lower secondary school mathematics required, plus, minus, multiply, divide. Sec 1, Sec 2 is good enough, right? It's good enough to attend my program, right? One case study is Donna Darrington of batch 9. She made her first dividend in 16 days after attending the course, right? She is the lady on the right, okay? And she got $68, all right? Her first dividend, okay? And she was in between jobs when she signed up for my program. So I guess she was able to have the confidence of figuring out how to use her money to make money. I think that's very important and a good confidence booster. And then within a year, she was able to get her first golden goose, right? She carries on and she has a much larger portfolio today. right? The important thing is that she knows how to use money to make money, and at the same time, she can make money using her time, right? So very good, right? Multiple streams of income. All right, so at this point of time, the only thing you need to ask yourself is what is the value of your personal freedom, right? If the cost takes you 20% towards your retirement target of 500,000, and then you'll be $100,000 richer, at 20% of this $100,000, the cost is worth $20,000 already, right? And the sample strategy is something that you would typically get at the end of the course, where I'll create a write-up and I'll send it to you. This is a unique PDF that can only be built if the trainer is also knows a little bit of full stack engineering, all right? So this PDF contains a regime chart of the portfolio the class is built, along with important financial statistics like what the drawdown is, what is the standard deviation, what is the return. Right? To generate this using a Bloomberg terminal, you need at least 3 months of Bloomberg usage, and you also need to teach yourself how to use Bloomberg, right? So your man hours will be used. Easily reach a 5-digit kind of cost if you want to do it on your own. We have a beginner's guide that will coach you to get you your first trading account. I mean, I would obviously prefer students to come in with a trading account already so that you just need to learn what to invest in rather than how to invest. But we know that there are people who are coming in with no prior knowledge, and we've prepared a beginner's guide for you. All right. And the amount of hand-holding that you need to do this, right? The coaching can be worth a lot of money, right? In the thousands. All right. So this is the beginner's guide that we have. We have a network of partners and tools like Stocks Cafe and Quants Cafe, where students will be able to use your software at a discounted rate. All right. Now, my program doesn't involve expensive software that we sell to you. Okay. I want to emphasize that if you use Stocks Cafe and Quants Cafe at the same time, it will cost you, I think, less than 10 Singapore dollars a month. All right. Less than 10 Singapore dollars a month. But all of you will have to sign up in order to be able to use it for my lab. All right. Okay. So this is a very cheap offer, right? And it's partly because the software engineer behind this platform is also a student of the program. I make sure that they understand what I do before I have this arrangement with them to direct students to their platforms. And finally, once again, the best deal comes from the Early Retirement Facebook group, where I will be there permanently with you to walk you guys through, to share some articles with you, and to explain what are the problems that we're facing right now in the financial markets, right? This is a difficult time for dividends investors. So you sort of need a cheerleader as well, right? To tell you that things are going to get better, interest rates are going to go down maybe in 2025, right? Things like that. Okay, but more importantly, future PDFs produced by future batches of students will be made available to you, and you can also assess the output from students in previous batches, right? You can do all that. Okay. My next session is on the 11th of June, all right? Foundations of Personal Finance, Understanding the Economy, how we invest. Okay, then we'll go through individual sections on fixed income, business trust, blue chips, small caps, REITs. And then after that, we will round it up with training on leverage and how the CPF and SRS system works and how to combine all this with CPF and SRS, right? So that's 4 days of online webinar over Zoom. And then on 15th of June, 9:30, we will have a final quiz with prizes. Then we will recap everything that's been taught, and we will build a portfolio that we will invest in on Monday. All right, so let's summarize everything that you will get. The value is easily in the 5-digit region, but the cost of the program is 3,888. And if you were to look at the promotional price by answering Dr. Wells' form, the price is $2,568, all right? About $200 every month if you pay by installment. So you have enough capital to get 2 golden goose, right? The cost is free because you can use your dividend payouts to supplement the credit card sort of installments, right? So who are the best people? Obviously, if you have $100,000, you can get 4 golden goose, right? The dividends alone after a year would be about $5,000, right? And we're not even talking about capital gains. Very easy for you to break even after attending this course, all right? So there is a slight bias where if you have a higher range of capital, this course is better for you. All right, come for the first day of the course. If you're dissatisfied with what you're learning, you feel free to exit and we will refund all your money back to you. Let Dr. Well know that you want a refund within the first day of the program or the second day of the webinar. Okay, within the next 72 hours, I will include 3 PDFs containing 3 books that I've written, and a collection of investment articles that come from the Dr. Well blog, and 2 bonus lectures, one involving earning more money and one involving saving more money. All right. This is the cost, timing, and the price. I'm just leaving it here for you to take a screenshot if you wish. All right. And I'm now going to go into Q&A. So I have a few slides more, and I will do my best to try to answer any question that has appeared on the chat group. All right. And you can add questions along the way. All right. I'll do my best. Okay. Hardef Gill, is it good to buy 3 local banks at their present prices? Okay. The 3 local banks collectively give between 5 to 6% dividends, right? So they are good when interest rates are high, right? When it is higher for longer, our banks will continue to outperform. But if interest rates start dropping at the beginning of 2025, for example, your banks will slightly underperform and your REITs will outperform, all right? So what I always suggest is try to combine banks and REITs at the same time so that you won't be affected by changing interest rates, all right? So is it good? Yes, it is, right? Better if you can combine it with real estate investment trust. All right, Janice Tan, why not just buy Singapore bank shares for the dividends? Yep, nothing wrong with that. REIT seems to have rights issues. Yep. But REITs will do very well when interest rates go down. So I think that sort of answers the question as well. I don't consider banks and REITs to be mutually exclusive. For me, banks and REITs, they play the same role, right? When interest rates are moving in a different direction, the different asset class will benefit. So I wouldn't really recommend that you fixate yourself on banks at the moment, right? Daniel C, what criteria do you use to review to stay convicted and calm, right? There's not a lot of conviction if you just collect dividends on a regular basis. So long as the REIT or the bank or whatever blue chips or small cap stocks generate cash flow for you and the business is stable, then I will continue to remain invested. Now, we are not speculators. We don't really care about stock prices. And I'm generally unfazed by the ups and downs of the financial markets. But I do care about the underlying business, right? Where the underlying business changes, people become corrupt, there is litigation, then maybe I will sell, right? Otherwise, I do try to stay invested for as long as I can. Julia, hi Chris, thanks for sharing the $100 a month dividend from 24,000 and your capital just showed 2.4 million. No, that's a different slide, right? Okay, that's a lot of interest to pay, no? I don't understand your question because my $2.4 million in capital, it's not leveraged. Yeah, I know it's large. It's not leveraged, okay? The 2.4 million portfolio that I demonstrated on the slide, it's part of my net worth, all right? It's part of my net worth and I don't borrow money to achieve that, okay? Yeah, so I don't pay interest on that. Yeah. So Janice, if no 100K on hand, what is the minimum amount to start that is still meaningful to earn decent dividend? About 8 to 10K, right? The thing is to just get used to the idea they can get $40 to $50 on a regular basis so that you will understand how to use money to make money, right? Don't go through life just selling your time for money, right? Yeah, learn how to use your money to make some money for you so that you know how to have multiple sources of income. And so you won't come under the mercy of the people at work. I think that is a fundamental message, right, of the 4 seasons. All right. Yeah. And I guess that's it. After Janice, that's all. I don't have any other questions at the moment. All right. If any more questions, just write to Dr. Well, and Dr. Well will direct the questions at me. All right. I'm going to close up now with just a few more slides. The final question that you should be asking yourself is, where are the customers' yachts? Right? The trainer, yeah, multi-millionaire, but what about his students, right? So I left the best example at the end. My best student is actually a couple, high-powered finance executives in their mid-30s. The husband attended the class on December 2019. The couple have a strong foundation in finance. Prior to the course, the husband and wife farmed $30,000 to every ERM portfolio built by students from December 2019 to the present. And it is a margin account. They leveraged and they invested through the 2020 pandemic. Okay. With an internal rate of return of 10 to 11%, they were making 17% a year. In less than 2 years of accumulation, the portfolio size reached over $1 million. So half the portfolio is owned by the couple, the other half is owned by the broker. but to achieve 7 digits within 2 years of attending an investment course, it's almost unprecedented, all right? Which is why they're like my friends now. Yeah, I occasionally ask them how their portfolio is doing. And with that, I hope that you'll be willing to reinvent yourself for 2024. Give yourself a chance to pick up some skills on early retirement. Let it change your destiny. Let this be the new Singapore dream. And I hope to see you in class in June. Have a good night. Have a good evening. Thank you very much.